So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I am joined today by Thomas Castelli. Thomas is a CPA, tax strategist, and real estate investor who helps other real estate investors keep more of their hard-earned dollars in their pockets and out of the government's. Short and sweet. I love it. Straight to the point. Who doesn't want to keep more of their money, right?
Who does not?
Awesome. Well, Thomas, thanks so much for coming on. It's great to have you.
Thanks for having me. It's an honor to be here.
Absolutely. So before we jump into tax strategies and things, give us kind of a, Reader's Digest version of how you got into real estate investing and kind of this area of tax.
All right. It's a great question. So way back when I was in college, I was studying accounting and I was like, there's got to be a way to build wealth. And I know getting a job and the whole nine isn't always the best way to do that. So I kind of stumbled upon real estate after reading the Rich Dad Poor Dad books, and the rabbit hole goes pretty deep from there. But pretty much when I got out of college, I went to a seminar on how to invest in real estate syndications and how to syndicate deals yourself. And I kind of fell in love with the idea of syndication. And so I basically, long story short, went through like a syndication coaching program, for lack of a better way to put it. And I learned how to invest. So I started investing as a limited partner in a bunch of deals. I eventually became part of a sponsorship team that closed on an 82-unit apartment complex in Jacksonville, Florida, back in 2017. And we sold that at the height of the pandemic. It's just the way the cookies crumbled. We were set to close in March. The pandemic hit in March. They exercised their 2 extensions on the contract, but we eventually sold it in May of 2020. And since I've just been investing in some limited partnerships, and now I'm looking in to buy some properties directly myself. So that's how I got into real estate investing. And then around that same time, we did the deal in Jacksonville in 2017. I met Brandon Hall, the founder of the Real Estate CPA, and I let him know, hey, look, I'm looking to get into real estate tax, because just kind of married the passion of real estate, my background of tax, and took up a position here, worked my way to partner. And so that's kind of how I got into it. It's a great way to blend the real estate side with my background. And that's in a nutshell how I got to where I am.
Awesome. That makes perfect sense. So before, did you have an initial focus in terms of your accounting? Were you just going to be kind of a general CPA or?
Yeah, that's a good question. So I came out of college and I started working for a firm called BDO in audit. So BDO is a national firm, and while I was there, it was very corporate. We had a lot of corporate clients, and I was like, this really isn't for me. So I fought tooth and nail to try to get into their real estate group, and they basically didn't have an opening, and they kept telling me when there was an opening, they would be there, but I got kind of antsy. So I ended up leaving, and eventually I realized that tax was probably more of what was more appropriate for me. So that's kind of when I met up with Brandon, and we were able to make something happen here. And I started working for his firm, and that's the rest is history, I guess you could say.
Awesome. I love that. Yeah. What a great field. And obviously, especially this time of year, it's top of mind for everyone. So let's kind of jump into it. We're kind of talking offline. We'll kind of start with passive investors, kind of give a high level overview of some of the opportunities that are available and kind of go from there.
Yeah. So from a high level, the best way to explain this is the top benefits of investing in real estate from a tax perspective, right? So when you have earned income, so when you have a job or you have an active business you participate in, maybe you're a consultant or whatever the case may be, you just have your own business, that's called earned income. And earned income is taxed at your ordinary income tax rates up to 37%. And earned income is relatively difficult to shelter. Now, it can be sheltered. You can you contribute to retirement accounts, HSAs, make charitable contributions. Of course, there's tax deductions for having a house. You have the interest tax, the mortgage interest deduction, There's tax credits for going to school. There's things you could do to reduce your taxes, but not by much. And in most part, to really make any significant damage, you're either deferring to your tax liability, you're either deferring your income through retirement accounts or making charitable contributions. And that's obviously money you cannot use today. But here enters real estate. So real estate's what's known as passive income. All rental activities are passive by default in the tax code. So unfortunately, you can't. Well, let me back this up. So the way it works is when you invest in real estate, typically what's going to happen is you're going to have a depreciation expense if you invest in rental real estate. Now that depreciation expense is a non-cash expense, meaning it shows up on your profit and loss statement, but does not take any money out of your pocket. And so to give an example, let's just say you have $10,000 of rental income that you earn from your rental property or from a syndicate you invest in, whatever the case may be. And you might have, say, $6,000 of hard expenses. And what I mean by that, that's expenses, that money that you actually have to pay someone else that leaves your pocket: utilities, property taxes, property management fees, repairs, maintenance, etc. Now let's just say that represents $6,000 of your expenses. So you had $10,000 in income, $6,000 expenses. Now let's say that you have a $5,000 depreciation expense. So now you're at a loss of $1,000, meaning for tax purposes, this means when you file your tax return, you're filing a loss, meaning you didn't pay any tax on the rental income, despite the fact that you pocketed $4,000. You now pay no taxes on it, and now you have another loss. So the next question is always, well, what do you do with the loss? So the first benefit, just to be clear, is that when you invest in real estate, you're sheltering your rental income, not paying tax on it through these losses. So that's just the first benefit. You can't really do that very easily with earned income. And that in and of itself is a huge benefit. But now you have this loss. And what happens with this loss? Well, this $1,000 loss that you have, if you don't have any other passive income for that year, that loss is going to get carried forward and can be used against other passive income, or rental income in our cases here, in future years, or from the gain on the sale of property that might happen in future years. So that's another benefit. You're kind of kicking it down the road. Now, where you can really throw fire on all of this is with something called cost segregation studies. So cost segregation studies, long story short, break down the components of your building into different class lives and can be depreciated faster and increase your depreciation expense even further. So if you run a cost segregation study, generally between 20 and 30% of your property's purchase price can be depreciated in the first year, thanks to what's known as bonus depreciation, which can increase your losses significantly. Now, again, for the most part, if you don't have any passive income or losses, that loss is going to be deferred. It cannot offset your earned income, generally speaking, and we'll get into that in a second. So one way to do this, if you're a passive investor, is just to make sure you have enough passive losses by investing in real estate and making sure that you're running a cost segregation study, or if you're doing it through a syndicate, that they're running a cost segregation study, so that you're banking these losses for the future, so that you're just effectively kicking the can down the road and not paying taxes on your rental income. And that makes sense, because if you didn't do that, you'd have to pay tax on your rental income or on the gain on sale. And that's money that you have to pay the government that you can't use. If you by deferring it and taking that money back, in your pocket, you're able to reinvest it and continue to grow your wealth. Now, there's some really powerful things in the tax code. There's something called the real estate professional status. And if you're a full-time investor, effectively, the real estate professional status will allow your losses from your rental real estate to turn non-passive. And when they're non-passive, then you can use them to offset your earned income that you earn from a job, or you earn from your active trader business. Now, the issue with the real estate professional status is in order to qualify, you need to spend more than 750 hours in a real property trader business, and it must represent more than half of your total working time. So if you have a day job, like me, I'm an accountant. I'm working, the IRS considers you to be working 2,080 hours per year. So in order to qualify as a real estate professional, you need to work 2,081 hours or more in a real property trader business. So you'd be effectively working 81 hours per week, every week, for the entire year, which is virtually impossible to do, as proven by the tax court. So one way you can qualify as a real estate professional is perhaps by having your spouse qualify. If you're married, one spouse could qualify as a real estate professional, and say the other spouse has a high income job or has a high producing business with a high income. One spouse can qualify, do everything I just said with the cost segregation studies, take those losses, and those losses, instead of being suspended and carried forward, would just offset the income that the other spouse generates.
What do some of these activities look like in order to qualify for a real estate professional?
That's a great question. So to qualify as a real estate professional, you need to work in one of 7 different types of real property trades or businesses, which includes basically brokerage, construction, development, management, redevelopment's another one of them. Effectively, those are the core businesses that you're going to be working in. And typically what you're going to see many people who do this are either going to be full-time rental investors. So you just own a rental portfolio. You can qualify as a real estate professional that way. You can qualify as a real estate professional by being a real estate agent or broker. You can qualify as by being in construction or by being a developer or fixing and flipping properties. These are the type of activities that are going to allow you to qualify and meet that 750-hour requirement. Now, I do just want to point out that, say you're an agent and you spend however many hours, say 2,000 hours as a in being an agent. Well, you qualify as a real estate professional, but in order to take your losses from your rental properties, you must also materially participate in your rental activities. So if you're an agent and you generate a lot of commissions and you have a handful of rental properties that you don't touch, you have a property manager, or you just don't really spend much time in, those losses could still potentially be passive. So in order to turn them non-passive, you must meet one of 3. There's 7 tests, 7 material participation tests, but typically we're focusing on 3. And the top 3 are going to be either you spend 500 hours on your rental activities, and that's it. You materially participate 500 hours, or you do substantially everything, which means you have virtually no outside help on your rental activities. You manage everything yourself. You do all the maintenance yourself for the most part, or you spend more than 100 hours on that activity and no one else spends more time than you. If you meet one of those requirements, then your rental real estate's non-passive. Now, if all you have is a rental business and that's all you do, and you're able to meet that 750-hour requirement, you've met that 500-hour requirement I just mentioned on your way to that 750 hours. But in a nutshell, that's kind of how you would qualify as a real estate professional.
Got it. Okay. So going back to being passive, with passive income, you can still take those losses, right? But only against the passive income.
Correct. That's 100% correct.
Okay. Got it. Got it. So I guess now kind of talk about, so you kind of alluded, if you're only a passive investor, like that's what you do, right? That's how you make a living. That's now considered active income, but you're also considered a real estate professional. So then those losses can also count against that as well.
Right.
Okay. All right. That makes perfect sense. So kind of keep going how you were on the high level stuff, then, some of the other strategies and things that are available as a passive investor.
So, so as a passive investor, specifically the biggest strategies that's open to you is just, again, making sure you have enough passive losses to offset your other passive income. That's just by monitoring your Form 8582 on your personal tax return, your Form 1040. There'll be that Form 8582, which is going to show you how much passive losses you have. So to kind of give an example, say it's 2022 and you're going to be selling a property, or you're invested in a syndicate that's going to be selling a property. You're going to want to look at your Form 8582 from 2021, assuming you file your 2021 tax return already or whenever it is filed. You're going to want to look at that Form 8582, and it's going to show you how much passive activity losses you have carrying forward into 2022. And if you know the gain on sale is going to be, let's call it $50,000, for example, and you have $56,000 of passive losses on your Form 8582, you're probably in the clear and don't need to do anything. Those passive losses will offset the gain and you won't pay taxes. But now let's say you look at that Form 8582 and it says you have $30,000 of losses. Well, you're going to have to ask yourself, well, how much losses am I going to have in 2022? You might be able to estimate that. And if you still don't have enough, after you add the expected losses you have in 2022 to what you have from 2021 that's carried forward, if that's enough to offset the gain, then you're in the clear. If it's not, then what you can do is you can invest in another rental property, or you can invest in a syndicate that will use a cost segregation study, or you perform the cost segregation study you have one performed on your property that you acquired directly. then those losses from that year, from 2022 in this example, will also help offset the gain on sale. So kind of just to summarize that, when you're selling a property, one way to minimize the taxes there is by just using passive losses, either that you have from prior years or that you can get in the current year to offset the gain. And effectively, that's what's available for passive investors. And then for active investors, you have that real estate professional. And there's one more that I want to point out for people that's been very powerful and very popular over the last 2 years or so, and that's short-term rentals. So there's a loophole in the short-term rentals, right? So all rentals are passive by default, but the short-term rental regulations say that if you have a property with an average stay of 7 days or less, that it is not a rental activity. And when it's not a rental activity, it's not passive by default. So it's just a regular business. Now, in order to turn a business passive or non-passive, because businesses could be passive and non-passive too, it all depends if you materially participated. So if you have a short-term rental, 7 days or less, you can effectively run a cost segregation study on that short-term rental, generate a massive loss. And if you have an average stay of 7 days or less, and you materially participated by one of those 3 tests I mentioned earlier, 500 hours, you do substantially everything, or 100 hours and not more than, and no one else spends more time than you, then those losses will be non-passive, and can offset your earned income without needing to qualify as a real estate professional. So it's been really popular because you have, in my experience, you have people who have income and they want to minimize their taxes. They look at their tax return like, wow, I'm paying a lot of money in taxes. How do I get rid of this? Well, real estate professional is not always an option. Either they're not married or both spouses are working and can't qualify. So instead, what you can do is invest in a short-term rental, 7 days or less, and then meet one of those tests, and you can then take that income against those losses against your income, which has been very lucrative. I'll say that.
Wow, that's incredible. So there's all these very clear incentives, let's call them, to invest in real estate. Is there a specific reason why there are so many tax incentives centered around real estate activity?
Right. That's a great question. So the way the tax code is kind of written, when you start to view it in a certain way, is that the government will incentivize you to do certain things and participate in certain activities. Like, to give an example, I'm going to get to real estate, but to get an example, like to go to college, there's the American Opportunity Tax Credit. You'll get a tax credit for going to college. There's tax credits for having children. There's tax credits that they're proposing to invest in electric vehicles, right? Because they want more people to invest in electric vehicles. So by giving you tax incentives, more people will do that. Now, real estate specifically is a fundamental need of human beings, right? And the government prefers not to do that in the public sector. They prefer not to develop property themselves. So they would rather incentivize people to provide housing, and there's a very strong need for housing, especially in today's market. There's such a fundamental supply and demand gap. There's so much demand and not enough houses that they want to incentivize people to do this. And one of the ways to incentivize people to do this is by providing these tax benefits to people who want to partake in these activities. So that's, in a nutshell, why there's so much out there, because the government wants the private sector and prefers the private sector to build housing, to provide housing to the public, and the tax incentives support that activity being done.
Interesting. That's awesome. And makes perfect sense, right? Obviously, like you said, it's a fundamental need to need a roof over our head. They're not going to get into the public sector, so they're incentivizing us to then continue to build and do all these things, which building, like you said, developing is one of those 7 kind of activities. So now let's kind of switch gears. What are some of the misconceptions around these incentives?
Right. So, I mean, the biggest misconception that people have is that passive losses will offset your active income. That's the biggest one. People still coming to us to this day thinking that if they invest in real estate and they have a loss, that they'll be able to offset their active income. And that's just not true. Unless you're a real estate professional, your passive losses will be passive. The losses from your rental income will be from your rental activities, will be passive. Another misconception is that passive losses can offset portfolio income, and portfolio income specifically would be, they say, from capital gains or dividends from stocks, bonds, mutual funds, REITs, the like. That's categorized as non-passive. That's categorized as non-passive in the tax code, which is just means that it's your passive losses just won't offset that. So that's another major misconception. Trying to think of some other major ones. I mean, those are the two major ones that I see around these. Another one is that here's some more that that if you buy a short-term rental, here's some around short-term rentals that you can pretty much live in it as much as you want and still take the losses. For short-term rentals, in order to make this work, what I had mentioned before, you cannot live in the property for more than 14 days or the greater of 10% of the days rented. So effectively, for most people, it's going to be 14 days. So you can buy a short-term rental, you can go stay there for 2 weeks, or a week here, a week there. But once you hit 15 days or more, for the most part, that's going to be considered a residence. And when you have a residence, the losses on your residence, your expenses are limited to the income you generate from the residence, and it cannot produce a loss. So that is a common misconception people have. Even real estate professionals have that misconception too about long-term rental properties as well.
You can do that as almost like a timeshare, right? Where you like spend a week and then rent it out the rest, spend a week, but after that it's capped. In order, you got to stay at that 14-day mark. How do they track that though? Is that something that can be tracked? Like,
yeah, it's a good question. I mean, it's more or less along the honor system, I suppose. There's ways that if you were to get audited, they could request credit card statements. They could request bank statements, things like that might be able to tie your transactions that you conducted to that area. And they might be able to say, hey, look, why were you in this area so much, in this vacation home? Obviously something's going on. I mean, that's the way I think they would be able to do it. It hasn't really been that big of a factor. I've never seen anybody actually get audited for that before.
right.
But those are just some of the tools the IRS has used in other instances. And I just would imagine they would pull the same tools out there.
No, that makes perfect sense for sure. So awesome. So we kind of covered, the passive side. We'll get to the active side, but before we do, is there any legislation that you're kind of keeping an eye on, or things that, I mean, obviously bonus depreciation, this is the last year of 100%. Mm-hmm. Hopefully, they revisit it and we get to keep it. But as of now, next year, it'll drop to 80% and right. So on. But is there any other legislation that you're keeping an eye on that kind of affects some of these incentives?
Yeah, that's a great question. So right now, Biden's tax plan he announced last year in 2021 is pretty much dead. However, they did just announce that they did send the 2023 budget proposal to Congress. And in the 2023 budget proposal, it basically says that they want to increase the top tax bracket from 37% to 39.6%. So that would increase. They want to get rid of the carried interest loophole. So carried interest. So if anybody out there syndicates deals, that promote that you get, say you split the profits with your investors 80-20 or 70-30 or any combination thereof, whatever the sponsor gets, that's typically their income is typically taxed as capital gains when it's sold. The capital gains tax rate if they hold it for more than 3 years. And what they want to do is they want to have that taxed as ordinary income, because they view that as that they view the quote unquote sweat equity as earned income, because the sponsor's earning that for putting the deal together. They're earning it for managing the deal and making sure that everything goes through. So it's not really like a capital gain. It's more akin to earned income. So they're trying to get rid of that. That's been on the chopping block many times before and is yet to happen, probably because if I had to guess, a lot of Wall Street people and Wall Street PE firms are probably not going to let that happen. So there's a lot of lobbying going on against that. But nonetheless, that's what they're proposing. They're also proposing to eliminate the 1031 exchange, which has been also on the chopping block many times. In 2017, so prior to 2017, in the Tax Cuts and Jobs Act, you were able to 1031 exchange almost any capital asset. Like you could do a 1031 exchange on a business vehicle or a piece of business equipment, and they narrowed it down to only real estate in 2017. So that's good for real estate investors, but now it looks like they want to take that away completely. And then there's just two more things in there that kind of stuck out. One of them is they want to do a 20% minimum tax on anybody, on any household that has a net worth of over $100 million. So I don't know if anybody listening to this that's gonna impact you, but that's what they're proposing there. And there's one more thing there. I forgot what it was. There was something else that they were trying to do. Gotta be honest, I forgot what it was, but if it comes to me, I'll definitely bring it up. But that's
absolutely. So obviously you can speak to this, and of course, the tax the rich and this whole thing, and oh, Trump didn't pay any taxes has been a thing even before Trump was president, all that. But really, when you break it down, what you start to realize is that they don't have earned income. The way that they make their money is through these incentivized pieces that allows them to then carry losses, and some of these losses are massive losses, and carry these through and not pay taxes, and they're not doing anything wrong. So like I understand taxing the ultra rich, but like if a household has more worth $100 million and we have this extra 20% tax, where is that going to go if they don't actually have earned income according to all these IRS codes?
Yeah, so it just gets carried forward as an NOL. So if I'm not mistaken, the way Donald Trump was able to take all those losses, because when he sold his casinos back, whenever they went back, he went bankrupt and all that casino happened. He had such large losses, which are called net operating losses, that he was able to use them to offset his income significantly over the coming years. So that's pretty much how a lot of these people say you own a business and the business is defunct or it goes bankrupt or whatever, you might have these very large losses, similar to kind of what we're talking about real estate, but from the business side, that can be carried forward and used to offset your income in the future. And that's called a net operating loss that typically comes from operating businesses. So that's how they do it. But again, the reason why businesses are also incentivized to do things like that is because if you're a business owner, you're taking on risk, right? You're taking on risk to start a company, go and start from ground zero or from wherever you're starting, and you're employing people, providing jobs, you're providing services to the community, etc. And the government wants to incentivize that too. They want to incentivize people to take those risks and provide jobs. So that's why those are there too. And it's just a lot of people who don't understand how the tax code works and how they start to view it in a negative way. But you really got to take a look at it. When you take a look at it through the frame of the government incentivizes certain things, it does make sense. Now, more recently, what they've been trying to do is say someone like Elon Musk, right? He might have a huge net worth because the stock in Tesla just keeps going to the moon, literally, but it's going to the moon, and he's not paying any tax. So what he can do is he can go and say, he can go to Bank of America or whatever bank and say, I need a loan. I need to buy a new yacht. So I'm going to go get a loan and I'm going to collateralize my Tesla stock against the loan. I'm going to get that loan and I'm going to go buy the yacht. And guess what? You didn't pay any capital gains tax, right? He didn't sell any of his stock to recognize a capital gain. And a lot of people are starting to look at that as being unfair, because what happens is rich people accumulate a lot of assets and then they just collateralize their assets and take out loans and just never pay tax. And that's what they're trying to claw back by saying, you're going to have to pay a minimum tax of 20%, because they basically want people to pay their tax. So.
Interesting. That's a really, really good explanation. I've never actually gotten a full explanation of that, so I really appreciate that. So we are running up against time. I do want to get to the active. Can you give just kind of a Reader's Digest of like what the active investors have available to them? Is it kind of along the lines of the real estate professional?
Yeah, absolutely. The biggest thing available to active real estate investors is going to be the real estate professional status by far. And if you're able to, if you're a broker or something along those lines, you're earning a lot of commissions, you can buy rental properties and offset your income with that. Those are the biggest ones. Other things that are available to active investors would be the 1031 exchange. at a 1031 exchange, you're not really going to see that too much on the syndication side. Certain groups do it, but in many cases, you're just not going to see it. But if you own property, you could say buy a property today and say it appreciates by $1 million, because who knows in this market, however many years later, you might want to sell that property and buy another property and trade up. But the problem is, when you sell that property, you're going to have to pay capital gains tax, and it's going to eat away at a chunk of your money. So, and a chunk of your buying power. So what you can do is you can defer that capital gains tax using a 1031 exchange, and buying another property using the entire sales proceeds, and effectively buy another property, buy a larger property, and not have to pay the capital gains tax. So that's another major tool available to active investors. And just kind of add on to that, there's something called 1031 until you die, where you could just keep 1031ing over the years and never pay capital gains tax. And then when you pass away, you can leave the assets, the real estate, to your heirs, and they'll receive it at the stepped up basis. So what happens in 1031 exchange, you start off with your cost basis or your original property. You're going to depreciate the property little by little, and the cost basis is going to be whittled down. Now, when you sell the property, you're going to have a capital gain. So when you do the 1031, your basis in the new property is not going to be the purchase price of the new property. It's going to be similar to the purchase price, similar to your adjusted basis in the original property, which is going to be lower. So if you do this over and over and over again, you might have a basis of like $100,000 in a property, but it could be worth $10 million if you did it over an entire lifetime. So what happens is you just leave that property to your heirs. They receive it at the $10 million. That becomes their basis, and no taxes ever get paid. And now they could turn around and sell it the next day for $10 million and have no capital gain. So that's a big incentive for real estate investors. Between that, the real estate professional status, like you could theoretically never pay taxes, but it's easier said than done. I'll say that, but that's what's available for the most part.
Of course. And absolutely. And I think that's everyone's ultimate goal. And why a lot of people get into this, especially passively, is for those incentives. So awesome. I've really enjoyed having you on. Appreciate all of this explanation. We're at the final 5 questions. It's the same 5 questions I ask all of my guests. First one is the best advice you've gotten from a mentor.
The best advice I ever gotten from a mentor. Invest in real estate. No, the best advice I got from a mentor was just know how. Okay, just realize that business is a people business, and the best skill set you can ever develop is your ability to work with people, especially in real estate and in accounting too, for that matter. But especially in real estate, it's all about people, agents, tenants, property managers. If you could. The better you can get at dealing with people and working with people, the more opportunities going to come your way, for sure.
Love that. That's awesome. What is it about your career that makes you feel like you're fulfilling your why?
So yeah, that's a great one. So part of my goal is to help people build wealth and build wealth myself, but help other people do it along the way. And by being a real estate tax consultant, effectively, I get to help people increase their wealth by paying less taxes. So it's very much in line with my purpose. And that's what it is. Can help people reduce their taxes, increase their wealth.
I love that. That's awesome. What's your favorite non-real estate or investment related book?
Non-real estate or investment related book. That's a good question. It used to be The Power of Habit, but I think it's becoming Atomic Habits. I just picked up Atomic Habits, and the identity portion of that book, I don't want to get too much into details, but is very powerful. I'd say that might become my top book. Either that or Never Split the Difference by Chris Voss.
Nice. Both great books. I just read Atomic Habits for the second time. One of my favorites, if not my favorite, for sure. If you could have any superpower, what would it be?
Any superpower? It's tough, man. It's tough. Teleportation.
Nice. I love it. That's such a good one. That or fly. You got it, right? Like, why not? Awesome, man. Last one. What's the best way for people to get a hold of you and, obviously learn more?
Yeah. So the best way to get a hold of me would be to we have a Facebook group called Tax Smart Investors, where we do like Facebook Lives, where we answer questions from people who are members of the group. It's probably the best way to get in contact with me these days. My email is like so flooded that like it's hard for me to keep up. So either that, or we do have a private community too at taxsmartinvestors.com, where you can join a private community, and we get even more in depth there. So those are probably the two best ways to kind of get in contact with me at this point.
Awesome. We will link that in the show notes. Thomas, thank you so much. It's been a pleasure.
Thank you for having me.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.